Hello viewers and welcome to our YouTube channel where we introduce share market and its operations to you in the simplest way. All you have to do is stay tuned to our channel for enhancing your knowledge base by subscribing to it. So today in this video we are going to talk about equity investments. This is amongst the most common terms you'll come across in your everyday trading life. To begin with, let's understand what is equity. Equity is basically the ownership of a business. A business is further divided into pieces called shares, and these shares are subscribed by people in exchange of money or sometimes non-monetary considerations. For example, I have 1000 shares of, let's say, ABC company. This means I am the owner of those 1000 shares, and if these shares represent 1% of the company's capital, I am the owner of 1% of business of ABC company. For better understanding, let's see another example. Let's say you are 4 people and each one of you brings 2 crores in order to start a business. Therefore, total capital is 8 crores. Let's say at the time of registration, this capital of 8 crores is divided into 80 lakh shares of rupees 10 each. Hence, each one of you holds 20 lakh shares which represent 25% of the company's capital or 25% ownership or equity. Let's take the story a little further. Say you and your friends now decide to sell 20% of your company's shares to public for raising money needed for expansion. 20% of your company means 16 lakh shares with a face value of rupees 10 each. Let's say in a case these shares sell for rupees 100 each, which is the market value, your company earns a premium of rupees 90 per share. But the ownership or equity will still be represented in the multiples of the face value, that is rupees 10. Simply put, if an investor buys 10 lakh shares, he is now the owner of 12.5% of your business. Therefore, an investor purchasing a stake in the company or shares of the company is said to make an equity investment. Now, how important are equity investments? Let's see it further. If your financial goal is a long-term investment, experts will always advise you to go for equity. Also, if you want to save taxes and beat inflation, equity is the best rescue. Let's understand this with an example. Let's say I have rupees 1 lakh in my hand and 2 options for investment. One is equity and the other is a fixed deposit. The rate of interest in a fixed deposit is say 6% and the rate of taxation is 30%. Therefore, after 20 years on maturity, the amount that I'll have in my hand is rupees 1 lakh plus interest, that is 0.5, which will be close to 2.28 lakhs. Now, if I had invested this money in equity with the assumed rate of return around 10%, after 20 years, this 1 lakh would become rupees 6.73 lakhs, which is almost more than double the amount that I have received in the fixed deposit. Here you can see how your equity investment value is more than double the return of the FD investment. Now, are you wondering how your equity investments will pay you? Well, there are 2 ways you can receive the returns earned. First, as the shareholder, you receive a periodic payment made from the company's profits as dividends. Secondly, when the price of a stock appreciates due to the growth posted by the company, resulting in capital appreciation. Now, you must be wondering to put all that you have in equity. Wait before you proceed. There is a thumb rule here that will definitely help you to find the right composition of debt and equity in your portfolio. This rule helps in asset allocation, which differs from person to person depending upon their risk appetite, financial goals, income, age, etc. The rule is 100 minus your age should be the weight of your equity in your portfolio. So say if you're 35 years old, the weight of equity in your portfolio should be 100 minus 35, which is equal to 65%. Hence, if you have rupees 1 lakh for investing, put 65,000 into equity and allocate 35% into debt securities. Here again, some of you might be wondering how much returns will you earn from equity investments? Well, returns from equities are uncertain. They are all based on predictions that are made after researches and thorough studies. Proper research and analysis of various factors involved may help you evaluate the returns you may earn from equity investment. And what are these factors? Let's see. These factors include domestic and global rate of inflation, interest rates, political economic environment, fiscal policy, and a whole lot more. Therefore, ideally before investing in company shares, your goal should be to find the right value. You need to do a thorough research, review the company's fundamentals, look into its historical performance, conduct a proper analysis before investing. Also, you should look for a long-term stability and strength of the company against its competitors. Now that you know that equity yields more profits than other forms of investments and how you should proceed, it is important here to mention that there are risks associated with equity as well. Yes, equity investments are not really risk-free. In case of equities, with great risk, there is a possibility of greater profits as well. And this is the reason for equities being preferred for growing a man's investment into wealth. When it comes to equities, there are two types of risk associated: systematic and unsystematic. Well, simply put, risks that affect the entire market and all the stocks are uncontrollable are systematic risks, whereas the risks that are particular to a company or industry and can be controlled through diversification are called unsystematic. For example, when the rate of inflation in a country rises, it affects all the sectors and companies, and you cannot save yourself from this risk. This is systematic risk. But if a company faces shortage of funds due to any reason that can be controlled by seeking help from other sources, this financial risk is particular to that company only, and hence it is unsystematic, and you can avoid it by proper diversification of your funds. Systematic risks are unpredictable and hence cannot be avoided, but you can always reduce the impact of them. You can mitigate such risks by allocating assets based on your investment goal, time horizon, and risk tolerance. Let's talk about 3 golden rules that can save your equity portfolio from risks. First, invest for long term. Second, diversify your portfolio. And third, take advantage of systematic investment plans, that is SIP, and systematic equity plans, SEP. Now that you have a clear picture of what to expect from equity investments, let's look at how you can start investing in them. Now, there are 2 ways of doing this. First, through direct investment in shares of companies where you will need an in-depth knowledge of the company and investors have complete control on these stocks. Remember, these stocks are highly volatile and you need a demat account to start with. Secondly, the investment through equity mutual funds where fund managers will do it all for you. They will invest in stocks of multiple companies through a single unit. All you need to do is complete your Know Your Customer process, that is KYC process, with an asset management company, a KYC registration agency, or a broker to start investing. I hope this video serves good help to you, my friends. If you like this video, share it with your friends, like and subscribe to our channel.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our social media handles to never miss an update from ICICI Direct.